in our discussion today, I'm not going to focus on, why Bitcoin. That's a whole separate topic that we could spend hours on. So the assumption here is that people understand and appreciate Bitcoin for what it is. Probably the most pristine form of money and store value that humans have ever invented. So if we accept that, then we can move on with this discussion. If you don't accept that, then none of this is going to make any sense to you. All of this is going to seem like a Ponzi, right? So that's kind of the first part of this. Now, whether you buy strategy versus Bitcoin, it kind of comes down to whether or not you think strategy can accumulate and grow Bitcoin per share. Now, historically speaking, the company has done a nice job at that. This is actually showing the number of sats per share since they started this strategy in 2020, right? So they had started out with 56,000 sats per share after their initial purchases through 2020. The following year, it grew by 47%. The next year, only 2%, 7%, 74% in 2024. And so far this year, through the end of July, about 25%. If you don't think the company can grow Bitcoin per share, then it wouldn't make sense to invest in this company. You'd be better off just owning Bitcoin directly. But if you believe that strategy can grow Bitcoin per share in a way that it doesn't put shareholders at risk, then it does become quite interesting. So let's just explore that a little bit more. So this is just a snapshot from Strategy's website, and they have a really nice website that gives you a ton of real-time data. Now, you can see right now that the market cap of the company, enterprise value, is about $108 billion. Okay, they have 639,000 Bitcoin, almost 640,000. It's more than 3% of the total Bitcoin that will ever be produced. And the total value of that Bitcoin holding right now is about 72 billion at current prices. When I ran this, it was about 113,000 per Bitcoin. And the company today then is trading at about 1.5 times their Bitcoin holdings. And the question is, does that make sense? What should the MNAV be? The multiple to the net asset value. Okay. Now, a couple of things I just want to draw your attention to, and as Joe talked about in this previous video, there's debt. The company has some debt. And right now, that's about 11%. Their debt to their Bitcoin holdings is about 11%. It's about 8.2 billion. But they also have these preferreds, about 6.5 billion of preferreds, and it's about 9%. Now, the interesting thing about this is that the debt is very low cost. Some of these converts have 0 interest rates, but you have to pay the money back. On the flip side, the preferreds have much higher dividend rates, ranging anywhere from 8 to 10%. But the bonus is it never needs to be paid back. These preferred stocks are stocks. They're equity. They're not debt, and they're permanent capital on the balance sheet. So in the evolution of Strategy's strategy, they really should never have done these convertible bonds, right? Because now they have to pay this money back. Now, the good news is that these convertible bonds will likely be converted to equity. So there's not much risk in terms of having to pay the bonds back. But there could be if Bitcoin goes down far enough. Just to drill down on this again, there's 6 convertible bonds. 4 of them are in the money, and there are 2 that are not yet in the money. Conversion price $672 and then $433. These 2 are actually at 0% rates. Doesn't show it here for this 2029 one, but this is a 0% rate. So the cost of this debt actually is extremely low. Okay. And then in addition to that, you can see the 4 preferreds. Okay.
And by the way, the preferreds are separately traded, right? They are tradable tickers.
That's correct. Yeah, they are. They trade like stocks essentially on the stock exchange. And here are the symbols.
And they're just paying dividends, right? You're just getting stock dividends. That's
correct.
The way they're paying interest.
Yep. They pay dividends quarterly for the most part, except STRC pays dividends monthly. And there's a few different wrinkles with some of these. For example, with STRD, they could elect to not pay a dividend if they felt like they needed to. And
others cannot elect that, so they have to pay?
Well, they could in an adverse scenario. They could choose not to pay, but there would be some consequences, obviously, to that.
So these are pretty interesting things, by the way. I'm not too focused on that because in Pioneer Lands, we are seeking high returns. But that is kind of an interesting thing. If you're seeking returns of 10% guaranteed or more or less guaranteed as dividends, there you have a bunch of stocks and they're basically issued by Strategy, a treasury company that is backed by a lot of Bitcoins, need 9 billion Bitcoin. And so if you're just seeking yield, not the worst thing, probably.
That's right. Certainly relative to a lot of other income producing investments out there, they actually look very attractive. Yeah. And that's not really the focus of this discussion today, but that certainly is something we're thinking about. So here's a snapshot at the end of the quarter. The value of the Bitcoin holdings back then was 74 billion. And if you back out the convertible bonds out of the money converts, that's about 5 billion. So they have about 69 billion of sort of Bitcoin then that they can use to cover these other instruments. And at this time, they had about 120 years of preferred dividends covered by this Bitcoin, holdings. Okay?
Only that Saylor pledged that he will never sell Bitcoin.
Right.
So
that's right.
But technically, of course, you're right from a financial perspective.
Yeah. Now, it's about 18 years of preferred dividends if Bitcoin declined by 75%. Now, what Joe did in his previous video was take a look at the real risk and this idea of implosion threshold and implosion risk. So let's just extend that a little bit. So, Joe, the numbers that you came up with was about 13,000 per Bitcoin. Now, the one thing that you didn't factor in was the dividends on the preferred. So instead of needing about 8.2 billion, it's more like 8.8. So if I update the numbers, today's Bitcoin price of 113,000, and if you take into account the debt plus the preferred dividends, if you wanted to make sure you had at least 1 year of preferred dividends covered, you would need at least 8.8 billion.
Yes, even though that's a little less of an implosion issue because you could just opt for not paying.
Yeah.
But if you're underwater on your debt, that's really, really bad.
There'd be some serious repercussions from a trust side of things in terms of the company being able to raise future capital if they didn't pay the dividends. So making it this more conservative, and that brings this implosion threshold to about 13,800 a coin, a little bit higher than the 13,000 that you had, but very similar.
Of course, some people argued in my comments that it's not really implosion. If Bitcoin drops to 5,000, it's not that MicroStrategy is out of business,
right?
But I would rather not hold the stock at that point.
Oh, it'd be carnage for equity investors for sure. Yeah. So the threshold here then is that Bitcoin needs to drop by about 88%. Now, this assumes a few things, right? It assumes that Bitcoin drops from today's level and stays there. And that's unlikely. It's going to bounce around and maybe even recover. It assumes that Bitcoin doesn't first go up before it drops. Let's say Bitcoin went up 100% and then dropped 88. Well, then it would be at 26,000 a coin and strategy would be fine.
Yes.
Right. So we're just looking at it, from today dropping 88%. It also assumes that strategy doesn't do anything while this is happening. It assumes that they don't raise capital and put some cash on their balance sheet and just let it sit there. So that's a pretty bold assumption to assume the company just sits there and does nothing. And then it also assumes that all the convertible bonds mature during this downturn period. And that probably isn't likely either. And
the way I think about these things is more, extreme case just as a heuristic. That's what we are looking at. That's the really bad point, 13,087% drop in Bitcoin. And then you have the path towards that down. Yeah. And this premium, 1.5, so 50% premium, you're paying 50% more than you would pay for Bitcoin raw. That premium, of course, on the way down evaporates more and more very likely. So if Bitcoin gets cut in half, that premium gets cut somehow, which means you are dropping more than Bitcoin drops on the way down.
The clearest way to describe strategy as an investment is it's leveraged Bitcoin. So on the upside, it'll outperform. On the downside, it's likely to underperform Bitcoin. Again,
the interesting thing, I think that's right. The interesting thing when you put the numbers together and think about, but how? What is the actual effective beta I get? That is very different from the effective leverage, of course, as we see, right? Because the effective leverage right now, including the preferred, is only 20%. But the beta is 50%, it seems. So that's a very complicated question because that goes into what the market believes. And that's, for me, the big, that's why for me, this is pretty speculative, the whole thing, because that premium, the MNAV is totally, no one knows, right? This is completely market. It's the level of belief. And that is the interesting thing we have to play around, I think.
Yeah, so it's interesting. So in normal circumstances, Bitcoin volatility actually is an opportunity for strategy to buy more Bitcoin at lower prices, just like for individuals to dollar cost average into stocks as they go up and down. That's a benefit. What we're worried about here is this implosion scenario, right? So it's also important to say that strategy recognizes that they don't want to issue convertible bonds anymore. And they have a plan actually to let those run out and equitize those converts. And something really interesting happens then when they do that. The scenario starts to look more like this, where you really only have to worry about whether they have enough capital to cover the dividend payments. So in this case, let's say there's no convertibles at some point, and you've got you've got 600 million of preferred dividend payments that you want to cover. In that case, Bitcoin could drop 99.2% and you still have enough capital to pay those dividends.
Yeah.
That seems pretty crazy at this point to say that Bitcoin is going to drop 99%. Again, if you're in the camp that you think Bitcoin is a Ponzi scheme, then you believe this.
But then you're also not in the market of deciding between Bitcoin and MicroStrategy.
No, you're not involved in this trade at all. That's right.
But so for me, this is interesting. That's an interesting detail. After I saw, first of all, I thought when I started my video or the research on my video, I thought, oh, I don't trust this, highly financially engineered, too much leverage, very dangerous. After I did my video and was done and saw that actual implosion risk that you need to drop 80, 90 or 87%, depending on how you compute it, I was already pacified. I was like, well, it's not really going to happen. Even if it happens, it doesn't really implode the company. It just puts them into a lot of trouble. But if my Bitcoin holdings go down 90%, I also am not that happy. It's kind of okay. So the implosion risk is one thing, and I'm sure you cover this in the following slides. For me, the question is then also the upside, where I'm more skeptical. Right? Am I really that much better off if Bitcoin goes to 200,000 to 300,000? How much better am I actually off, and what do I have to believe? Because when I put the hard numbers in, the leverage is 20%. So I'm getting 20% kind of guaranteed by the physics of finance, and plus a premium that is more, okay, that's not the physics of finance, that's the emotionality of the market. The physics of finance could tell us that Saylor has a strategy to increase these preferreds dramatically, right? Which would be interesting for me if you want, because that fuels the psychology and the physics. But I don't know anything about it. So maybe you talk about this later in the slides, but that would, so now we cover the downside a little bit, and everyone who is a believer in Bitcoin says, okay, fine, that seems like not too bad. But do I really get...
Let's just finish out the downside discussion real quick. There's a couple more slides I just want to share. This is one, this shows then if they only had preferreds, right? And let's say their dividends on an annual basis were the 8.8 billion that we saw earlier. You're replacing the converts with all preferreds, and you're scaling it up. In order to have 8.8 billion of dividends, you would need about 98 billion of preferred stock outstanding, assuming a 9% average dividend rate. Okay. Now their current Bitcoin is about 72 billion. So this would be more than doubling the Bitcoin per share. Now, I'm not suggesting that a company gets levered up to this degree, but I'm just showing here kind of an apples to apples basis. If the converts are gone, you can have a whole lot more preferred and still be in the same risk position that we're in today. Okay. Now, let's just talk about Bitcoin real quick in terms of its volatility. These are the annual returns of Bitcoin per year. And if you look at this, you can see 3 periods where this massive downturn, down 60% in 2014, 74% in 2018, and 64% in 2022. Now, in the early years, Bitcoin was a very small and very volatile asset. There was a period here where Bitcoin did drop more than 88%. It was down actually 93% at one point in 2011. I think it was November 2011. Okay. And you can see since then, Bitcoin's made new highs. It's come down, it's made new highs, and then we've had big drops again, right? But all the while, Bitcoin has higher highs, right? And higher lows. But these drops have still been pretty significant.
Yeah, in 2011, that was when the pizza guy sold his Bitcoins that he just made with the pizza.
Yeah, and the interesting thing about that, here, I'll come back to this. The interesting thing about that, back then, at that time, Bitcoin was about $110 million asset.
Yeah.
Right? It's over 2 trillion today. So, of course, the volatility of something that's only 110 million is going to be extreme, right? And it wasn't until about 2018 did it become a quarter of $1 trillion or $250 billion asset, right? So in these early years, it was crazy volatile, right? Now, the interesting thing is since 2014, if we back out those early years, the percent of time that Bitcoin was below 88% from its high is 0.1%. Okay, and I would even argue that using the data even from 2014 on, some of this data is horribly volatile as well. But certainly there's been a big drop in recent years. So we can't ignore that. We should expect Bitcoin to be very volatile. And by the way, it was interesting. Tesla didn't buy its first Bitcoin until February of 2021. And at that time, it was about $1 trillion asset. Okay.
Interesting, yeah.
So this is an asset that has evolved quite quickly and grown quite quickly. But I do think that the volatility of Bitcoin will be a lot less going forward because it's a bigger asset. And we now also have different sources of demand. It's not just individuals, it's institutions. We've got ETFs, and we've got 180 other companies like Strategy that are Bitcoin treasury companies to one degree or another. So as Bitcoin goes down, they're all going to be looking to buy more, which should provide pretty good support for Bitcoin price.